Okay, so in our last objective here, this is really we're talking about understanding the effects of inventory errors. And the bottom line is we have to understand that when we make a mistake in one period, if we never go back and correct it, that mistake is going to carry over to the next period. In other words, if there are errors in one period, then there's definitely going to be an error in another period, okay? Usually they're back to back, especially if we got it right at the beginning of the period and we got it right at the ending of the second period. So now the two had the beginning and endings from the two periods, but in between there were some errors. They're going to impact both periods. So what we find is that inventory errors counterbalance in two consecutive periods. The beginning inventory and ending inventory have opposite effects on the cost of goods sold. The beginning inventory is added and the ending inventory is subtracted. That's how we compute the cost of goods sold. So let's take a look. The easiest way to kind of figure this out and put it all together is if we just look at an example. So here we have a period one where the ending inventory is overstated. So we started off with $10,000 and we ended up, our ending inventory was $20,000. Now, apparently it was overstated by 10. So we had too much in inventory. Now, if that's the case, we use beginning inventory plus the purchases. That gave us the cost of goods sold. In this example here is $60,000. And then we subtracted our ending inventory, which we now know was overstated, but we're going to finish this off. We know it, but we know it after the fact. But in this case, we overstated our inventory by $10,000, but we used 20, so it happened already. So our cost of goods sold was computed to be $40,000. And that means our gross profit was computed to be $60,000. So you could see that the $100,000 of sales generated $60,000 of gross profit. However, we found out or figured out way after the fact that really that ending inventory was overstated by 10,000. That should have only been 10,000 because we miscounted, whatever it may be. So what this is going to remind us is that this ending inventory became our beginning inventory for the following period. So in this case, the beginning inventory is now overstated. So with this being overstated, we have more costs here than we should have. So beginning inventory plus 50,000 of purchases gives us a total of 70,000 available. And then we subtract the ending inventory. In this case, we assume this to be correct now. The ending inventory at this time was right, all right? And that gives us a cost of goods sold of $60,000. Now, between the 2 years, if the beginning of period one is right and the ending of period two is right, then we're good to go. We know that between the 2 years, we made $100,000. However, because ending inventory was overstated here, we ended up deducting more than we should have to determine the cost of goods sold. So therefore, the cost of goods sold was actually lower than it should have been. This should have been $10,000. If it would have been done correctly, this would have been $10,000. And then the cost of goods sold would have been 50. If the cost of goods sold would have been 50, then our gross profit would have been 50. As this carried over to the next period, this $20,000 error, this was overstated by 20, so that should have been 10, but it was over. So if you think about it, this should have been 10, this should have been 60. 60 minus the 10 would have given us 50. With that, then that means that our gross profit for the second period, 100 minus 50 should have been 50. So in both cases, to make it simple, the gross profit should have been 50. 50 in this period and 50 in this period. Now, if you add the two periods together, because we got this number right and we got this number right, we add the two periods together, it's still 100,000. But what we've done is we've overstated income in one period and understated in the next period. What's the relationship? The relationship is the fact that the ending inventory affects the beginning inventory for the following period. So if that ending inventory is wrong, it impacts two periods. Here's a graphical representation of what occurred. You can study that. Here's some guidelines for accounting for inventory. We went through all of this already. You can study that as well. And that's the end of chapter 6.